Welcome to the final part of Unit 4. Myself, Gokul. I'm working as an assistant professor in the Department of Master of Business Administration in Sri Muthukumaran Institute of Technology. This is part 4 of Unit 4 Dividend Policy Decision. In this session, we will explore the irrelevance theory, which is Modigliani-Miller method, and the bird in the hand theory. Today, we will cover Modigliani-Miller's irrelevance model, assumption, arguments, formula, and criticisms. Then traditional approach, residual theory. Then finally, bird in the hand theory. Let's begin with the famous approach. Modigliani-Miller proposed a revolutionary idea. Dividend policy does not affect the value of the firm. This directly contradicts Walter and Burton model. Key insights of this model are if a company retains earnings instead of paying dividend, shareholders enjoy capital appreciation equal to the amount retained. If it pays dividend instead of retaining, shareholders receive dividends equal in value to the capital appreciation they would have received. The conclusion of this model is the division of earnings between dividend and retained earnings is irrelevant from the shareholder's perspective. Then assumptions of Modigliani and Miller approach. Irrelevance model rests on several strong assumptions. Number one is capital market are perfect and people are rational. It means no transaction cost, perfect information. Then no taxes, corporate and personal taxes are ignored. Then third, floating cost are nil. No cost of issuing new securities. Then fourth, investment opportunity and future profit are known with certainty. This assumption was later dropped in the revised model. Then finally, investment and dividend decision are independent. Investment decisions are not affected by the dividend policy. These assumptions create an idealized world where dividend policy truly doesn't matter. Then MM's argument. logic is elegant. If the firm retains earnings, shareholders enjoy capital appreciation equal to the retained amount. If the firm distributes dividends means shareholders receive dividends, they can reinvest these dividends in the same company to achieve the same total wealth. Therefore, the shareholders' total wealth, which includes dividend plus capital appreciation, is the same regardless of dividend policy. Then arbitrage argument. If two firms are identical, expect except for dividend policy, investors can create their own homemade dividends by selling shares if they want cash or reinvesting dividends if they don't. This arbitrage ensures that cash or reinvesting dividends market prices remain equal. The formula for the approach I have shown in the screen. The formula shows that the current price depends on the total return, which includes dividend plus ending price, not on how that return is split between dividend and capital appreciation. Then criticisms of MM model, no perfect capital market, which means real market have transaction cost, information asymmetry, and imperfections. Second, existence of transaction cost, buying and selling shares cost money. Homemade dividends are not costless. And third, existence of flotation cost, issuing new shares cost money. Fourth, lack of relevant information. Investors may not have perfect information. Then differential rate of taxes, dividend and capital gain may be taxed differently. Then sixth point, no fixed investment policy. In reality, dividend policy can signal information about future prospects. Then finally, investors desire to obtain current income. Some investors prefer current dividend, example retires and will pay more for dividend paying stocks. These criticisms suggest that in the real world, dividend policy may matter. Then traditional approach is also called as residual theory, takes a middle position. The dividend decision is merely a part of the financing decision. The logic here is earnings may be retained for reinvestment, or if the funds are not needed, means it will be distributed as dividends. The key assumptions are investors do not differentiate between dividend and retention. The decision rule, if the firm has profitable investment opportunities, which means retained earnings. If the firm does not have profitable opportunities, it pays dividend. This is called the residual dividend policy. Dividends are what is left after funding all positive NPV projects. And finally, the bird in the hand theory. It associated with Myron Gordon and John Linter. It argues that the investors prefer current dividend over future capital gain. Origin of the name, proverb a bird in the hand is worth two in the bush, captures the idea. A dividend you have today is more certain than the promise of higher future value from retained earnings. The key arguments are uncertainty of dividend increases with futurity. Because of uncertainty, the discount rate increases with retention ratio. Investors prefer to avoid uncertainty and will pay a higher price for shares that pay higher current dividends. Dividend policy relevant higher dividend led to higher share prices. Let me elaborate on the theory's logic. Step 1, future dividends are uncertain. The further into the future, the more uncertain. So second step, because of this uncertainty, the discount rate cannot be held constant. It increases with uncertainty. Then step 3, investors are risk averse. They prefer to avoid uncertainty. Step 4, therefore, investors will pay a higher price for a share that pays higher current dividends or else constant. And finally, step 5, the appropriate discount rate increases with retention ratio because more retention means more uncertainty about the future dividends. Dividend today are safer than the potential capital gain tomorrow. Investors value this set. In the real world, transaction cost Information asymmetry and investors' preference dividend policy does affect firm value. However, the optimal policy depends on the specific circumstance of the firm and its shareholders. And that's brings us to the end of the Unit 4 dividend policy decision across both parts. Now you have a comprehensive understanding of the dividend decision, the third pillar of financial management, along with investment and financing decisions. Now, in next Unit 5, we will explore working capital management. Until then, keep practicing these concepts. If you found this video helpful, means please like, share, and subscribe. Leave your questions in the comments. Thank you for learning with me. Thank you.